Hi, I'm Linda Eads, and welcome to our webinar, How to Thrive in 2025. Now, this webinar follows one which was similar towards the end of last year. The title of that webinar was What's in Store for 2024, and we outlined 5 themes which we ascribed a higher probability of happening than the market was at that stage pricing in. And I thought that before we get into the meat of today's presentation, we should reflect on those 5 surprises and see how they turned out. So the first was that China would be one of the top performing stock markets in the world. Now, if we were having this conversation in early October, that would be a slam dunk, but China has retraced somewhat, and the US has taken back the lead following Trump's victory. However, it is fair to say that it is actually still outperforming many other major markets. So that includes the UK, it includes Europe, it includes India, it includes the broader emerging market universe, and that's all in US dollar terms. And by the way, we still have a month and a half to go, so we'll see how that turns out. Anything can happen. The second surprise was that even if Asia performed well, South African resource stocks would perform poorly. And that was actually indeed the case. Resources actually did not even keep up with inflation. They delivered 3.4% to the end of October, compared to financials, which have had a rip-roaring year, above 20% for the year to date in South Africa, and industrials, which are just shy of 15% as at the end of October. So I think we can give that one a tick. The third was, despite resources underperforming, the South African equity market would be up 20%. Now, interestingly, we know that the South African market has had a really good rally since the elections or the announcement of the GNU. And in US dollar terms, in fact, the market has actually delivered just shy of 20% because, of course, the rand has also strengthened over the year to date. So I think we can give that one a tick as well. The fourth was that oil prices would be over $150. Now, of course, that's one that we did get directionally wrong. We've seen that oil prices did go above $90 a little bit earlier on in the year, but they're now sitting at around $70. So that one, I can say we actually didn't get right. And then lastly, the gold price would rise above $3,000, which seemed at the time quite an outlandish statement. And yet we actually saw gold prices rise just above $2,800 in October. So it is off a little bit since then, around $2,600 at the moment, but certainly gold has had an amazing rally this year. It's actually up still more than 25%, so it's one of the best performing assets for 2024 thus far. So I think 4 out of 5, that's not a bad result. Today's discussion, though, is how to thrive in 2025. So it's not so much about sort of outlier surprises that might happen. It's more about the investment outcomes which we think will be key to driving, or investment themes rather, that will be key to driving investment outcomes next year. And to do this, I'm here today with 5 of our portfolio managers. So joining me here in Cape Town, I have our Chief Investment Officer Nick Balkin, Rashad Tayob and Vim Murray, who are both also portfolio managers here. And further afield, we have Brian Arcees and Ishrath Hassan joining us from our Singapore office. Now, each portfolio manager is going to outline an investment case. They're going to back up their views with a number of slides. I'm going to challenge those views with 1 or 2 questions. And at the end of the session, we're actually going to launch a poll where you decide who has presented the most compelling argument. So please stay online to give your input for that. So, firstly, let's start with you, Ishrath. Your investment case is that China will be one of the best performing markets in the world. Sounds familiar? Talk us through why you think there is still significant upside in this market.
Hello, everyone. So last year, we outlined that China could surprise as one of the top performing markets for 2024. Now, it didn't look like that was going to be the case in the first half of the year, but China has surged higher in the second half following the central government's announcement of comprehensive stimulus measures in September. Despite the threat of higher tariffs under a new Trump administration, China is on track to be one of the top performing markets globally this year. So the question on everyone's mind is, now what? What about 2025? In our mind, there's still a very high likelihood far greater than the market currently suggests through still depressed valuations, that China continues to be one of the top performing markets globally in 2025 as well. Let me try to quickly frame why. The current setup remains very attractive, particularly on a relative basis versus the rest of the world, and especially given that you now have a stimulus backstop from the central government across all fronts, from liquidity measures to monetary easing and fiscal stimulus. So just like the old adage, don't fight the Fed, the odds are stacked against a fight versus China's stimulus arsenal. If you look at valuations alone, China is the cheapest major market globally by far, both on an absolute and relative basis, despite the recent outperformance. While the macroeconomic backdrop has been challenging over the past 3 years, does the market really deserve to be less than half the price of the United States or 1/3 the valuation of India? China's economy is closer to a cyclical trough, while the US and India are likely near cyclical peaks. Even against markets with far weaker earnings growth like Europe or Japan, China trades at more than a 50% discount. Now, this is the market as a whole. And if we consider specific segments like the consumer or technology, the valuation discrepancy is even more stark versus global peers. It's important to understand that despite all the recent doom and gloom, the Chinese economy and consumer are still growing at a steady 4 to 5% this year. While China's real estate market has been a big driver of this underperformance and negative sentiment, the economic baton is now intentionally being passed from the real estate sector to advanced industrial manufacturing and consumption, as this chart shows. On the industrial front, China's strength is manifesting itself in leadership positions across clean energy, materials processing, automotive, and semiconductors. Some would argue that China is just getting started on many of these fronts. On the consumer side, the Chinese government has outlined at least $1 trillion in stimulus for local government debt swaps and property buybacks that should at the very least stabilize the real estate sector and elevate consumer sentiment from depressed levels today. On the company side, if you look at this chart, Chinese corporates are flush with cash. Excluding financials, they hold an estimated $2.3 trillion in cash on their balance sheets, equivalent to around 27% of their total market cap, which is amongst the highest in the world. They're now using this massive hoard to increase shareholder returns in the form of buybacks and dividends, as we've seen firsthand across our own equity holdings. The government is also actively encouraging buybacks, with the PBOC announcing a brand new relending facility that can extend $100 billion or more than $100 billion at an interest rate of 2.25%, intended to encourage listed companies to borrow and buy back stock. Most companies don't even need to borrow given their cash hoards, but if their businesses can yield more than this 2.25% interest and their growth prospects are intact, then it becomes very accretive to borrow and buy back stock, which many companies have already started doing. All these factors have led to total shareholder returns exceeding total financing proceeds in China for the first time ever this year. And as long as valuations stay near current levels, this is likely to continue to be the case next year as well. Finally, one only needs to zoom out on China and look beyond the immediate noise to understand the extent of the value proposition. The Hang Seng index is around the 20,000 level today, which is the same level it was in 2006, almost 20 years ago. China's GDP was close to $3 trillion back then. Today, it's almost 18 trillion. So the economy is 6 times bigger, but the market is just 10% higher, which shows you how negative sentiment has become. At the same time, China is now an industrial and technology powerhouse, which is different to even 5 years ago. They're fast becoming the most prolific automaker with more than 60% market share of electric vehicles and more than 80% share of electric batteries. If you believe that the energy of the future will be mostly manufactured, like solar, wind, or nuclear, versus being drilled or mined in the past, then China is positioned to be the world's largest manufacturer of clean energy products for a while to come. They're replicating this same industrial playbook in aerospace and semiconductors as well, which the West is now attempting to curtail. So, despite the possibility of higher tariffs and more geopolitical wrangling with the US, it's unlikely that such a powerhouse can remain at 8 times earnings for too much longer. Given the current stimulus impulse with the government, we believe that 2025 could be another strong year of outperformance for China, particularly given how expensive the rest of the world is in comparison. Thank you. And with that, I'll hand it back to you, Linda.
Thanks, Ishrith. I guess the question on everyone's minds is that, of course, in the face of a Trump presidency, there's a lot of talk of obviously rises in tariffs and an escalation in the US-China trade war. What if the Chinese equity valuations, for those reasons, just simply stay depressed?
Thanks, Linda. So I think it's important to go back to earnings, right? Chinese stocks have already been through a historic derating over the past 3 years, and maybe certain segments of the economy, like say real estate and construction, may remain depressed because earnings won't grow, but other segments like high tech and consumer should see growth and earnings return with increased spending within those specific sectors, which is exactly what the central government is trying to stimulate. Also, it depends on what happens to earnings with the rest of the world. US and Indian earnings, for example, are very elevated. And if Trump enforces his America First protectionist policies to the extent he's outlined, it could be highly inflationary and lead to massive supply chain bottlenecks for American businesses. This, in turn, could be bad for consumer sentiment and corporate America as well in the short term. There's also the possibility of a recession or an inflation-led sell-off like in 2022. So it's more a question of relative performance, in my view. Just given the current starting point, there's a lot more margin of safety embedded in the Chinese consumer and technology stocks we own than the American ones.
Okay, Ishrith, what about the fact that something we've debated around the table in our investment team is the excessive competition that we're seeing in China? Does that not affect the ability of Chinese companies to return, to generate decent returns on their capital in the sense that there's a race to lower prices, and that, of course, causes a massive erosion of margins?
That's a great question, Linda, and something we think about a lot. First of all, I think it's important where we choose to participate. We are not investing in heavily capital intensive, new cutting edge sectors or commodities where the steady state economics are very unclear to us. The auto industry is notorious for this. Even when the automobile was first invented, there were hundreds of brands that emerged, with more than 95% of them going bust over time. So that type of radical and uncertain change is definitely not something that would be attractive to us. What we do tend to invest in are businesses that already have proven economics and moats, which are evident in their returns on invested capital and their margins, particularly going forward. Often these companies have already emerged as clear winners from competition. They own the customer and have advantages like network effects, brand, or scale, where they're the lowest cost producer, which further reinforces their earnings flywheel. Now, that's not to say that those types of businesses also don't have competition from time to time, like we see in the Chinese e-commerce space, but it's a bet on management and their ability to weather the storm as well. So, for example, companies like Walmart and Costco have continued to thrive despite Amazon's growth and fierce competition. It also depends on your valuation starting point and what's being priced in and the variant perception we have on future earnings or value. So just for an example, we built most of our Chinese e-commerce position once competition had already ramped up, and when it became evident that market share was starting to stabilize and valuations approached levels that made no sense versus our earnings expectations. Alibaba, for example, was trading at less than 3 times free cash flow, excluding investments, despite their now stable and still dominant positions in e-commerce, payments, cloud computing, and AI in China. Now, when we do go into competitive industries, not just in China, but across the rest of the world as well, it tends to be at the very bottom of a cycle where we have a clear variant perception on the winner that would emerge from all the turmoil. The market is usually very pessimistic when an entire industry is losing money, which is clearly not sustainable and leads to often like supply consolidation and fantastic returns for the winner that emerges from that consolidation. I hope that answers the question.
Great, thanks, Ishrat. Fair enough. Let's turn to you, Brian. Your investment case for 2025 is that boring is better. Let me hand over to you to explain what you mean by that.
Thanks, Linda. When I think about how to position to thrive next year, I have to put my thoughts in context of the current macro backdrop. So while earnings expectations have been moderating in the US and globally, growth expectations still remain relatively robust. Excluding the more rapidly growing IT and comm services sectors, earnings expectations have declined as we move through this year, with year-on-year earnings growth 2024 over 2023 of only 3%. Despite these downward revisions, consensus expectations for next year's growth remain high. Earnings growth is estimated to exceed 10 to 11%. Now, at 22 times next year's lofty estimates and 20 times excluding IT and communication services, US markets are nearly 40% above their long-term averages. It's not to say that we expect multiples to converge to long-term averages in the near term, but it is to say that it is our base case that investors will have a better opportunity to deploy their capital in the coming quarters. So with that as a backdrop, my preferred positioning going into next year would be into defensive equities, which can be done without sacrificing growth, in particular in the utilities sector. I continue to believe that regulated electric utilities are undervaluing not only the growth that lies ahead, given the required electrification of all things, but also the certainty of that growth, given the regulated nature of their businesses. In particular, regulated transmission and distribution can offer high levels of stability, certainty of growth, and generate returns that are agnostic to power prices, as opposed to power generators, which will occasionally hedge, are far more geared to prices. Now, electricity volumes are expected to rise 2% annually after having been flat for nearly 2 decades. And the overall cost to the consumer is expected to be lower than what they currently pay today for energy. So as seen here, estimates are for electricity consumption in California, for example, to nearly double by 2045 to meet climate goals. And growth estimates themselves have nearly doubled over the past 5 years. The conclusion is that in an electrification of everything world, many regulated utilities will be once again growth engines, albeit modest but consistent, which is not priced into certain firms' valuations. Now, our portfolio holding Edison International CEO, Pedro Pizarro, he's viewed as one of the highest quality CEOs in the industry, having been with the firm for over 2 decades. He's a sought-after business leader, recently joined the board of Fortune 100 firm 3M. He's also one of the most forward-thinking utility leaders and recently commissioned an update to the firm's previously published white paper on what will be required to meet California's 2045, now legally codified goals. Now, it's worth studying these as many other jurisdictions are using these goals as a template upon which to base their own roadmaps. So in the study, the requirements to meet these goals are for more than 90% of light and medium-duty trucks, for example, will need to be electric. This is up from 3% and 1% today, respectively. 95% of building appliances will need to be electric, up from slightly more than 10% today. 3 times more utility-scale renewable energy will need to be brought online. And 15% of utility-scale generation will need to come from new or emerging technologies. And then really, finally, and most importantly, for how our portfolios are positioned, are that transmission and distribution grid projects will need to be added at 4 and 10 times their respective rates in the coming decades. Now, across the pond in the UK, the energy landscape is undergoing a similar transformation. Climate change and energy security are reshaping policy and driving substantial investments in renewable energy. The UK government's target of net zero emissions by 2050 is supported by Britain's energy security strategy and the UK net zero strategy, both of which view renewables as fundamental to achieving carbon neutrality, energy cost stability, and independence from volatile energy markets. Britain's energy security strategy includes plans to double electricity generation capacity with a focus on renewables, nuclear, and energy storage. And the net zero strategy complements this approach with a structured pathway for sectoral decarbonization, ensuring that interim milestones are met to sustain progress. So given these backdrops, how do we invest? Well, it's clear there will be winners in the new and emerging technology space, be it in hydrogen, batteries, long-term storage, etc. Many of these technologies aren't yet proven at commercial scale. While those that get it right will likely win big, those that don't are as likely to disappear. Both Edison and SSE are positioned in the portion of the transition that will be required regardless of what technologies emerge on the generation or storage side. It is estimated that for California alone, the state's annual 2 gigawatts of transmission infrastructure growth must increase to 7 to 8 gigawatts a year over the next decade. 120 gigawatts of the additional generation required will be by default a near doubling of circuit miles to handle the load. Now, the estimate today for this is to cost $75 billion. Separately, expansion of the distribution system to the end customer will require an additional $50 billion of investment. Now, at present, Edison is trading at 15 times 2025 earnings for 5 to 7% earnings growth out to the end of this decade, and also pays a nearly 4% dividend yield. Now, growth beyond that period will be at least as high, if not higher. It's effectively a low double-digit annualized total return for what is likely to be several decades of growth, trading at a 25 to 30% discount to the S&P. Now, our largest international fund holding, SSE, plays a critical role in the UK's renewable energy expansion by aligning its investments closely with national security goals. Focusing a lot on electricity networks, offshore and onshore wind, hydroelectric power, and emerging green technologies, SSE is really a cornerstone in the UK's energy transition. It's trading at an attractive multiple of 10.5 times earnings, a full standard deviation below its own long-term average, and also offers investors a 3.5% dividend yield, and earnings growth of low single digits today, but accelerating to mid-single digits in the coming years. While these are our preferred holdings within the sectors, we would expect well-managed, high-quality utilities in constructive regulatory jurisdictions to have similar tailwinds. So that's certainly my pick for 2025.
Okay, thanks, Brian. I guess one of the questions that springs to mind for me is that many of those types of securities are considered bond proxies. So would they not likely underperform in a scenario where we see inflation and thus interest rates re-accelerating or ticking up again?
Thanks, Linda. That's a great question. Now, often these are considered bond proxies, though I think it's a bit one-sided to look at them as bond proxies alone. So I'm generalizing a bit, but bond cash flows, right, in general, are not growing. They're also not inflation-linked. On the other hand, utility dividends are both growing and inflation-linked. So if you look at regulated utility returns, the returns to investors are determined largely by looking at the company's cost of capital, which includes the cost of debt, and putting an allowable return, right, over and above that cost of capital. So as and when the cost of debt rises, the allowable return will also rise. Now, it is true that there are lags between the time when yields rise and when this translates into the period where the utility can start to charge customers higher prices to compensate for their higher cost of capital. But over time, these mechanisms play out, and utility dividends are protected again against this outcome, and they grow at least in line with inflation, and faster in this case, given the structural growth that I spoke about earlier.
Okay, but now how does this more defensive approach or positioning dovetail with what sounds like quite a pro-cyclical investment view from Ishrith on China?
So to be honest, I don't really look at them. Our two views as opposing, where mine is defensive and Ishrith says pro-cyclical. I really categorize kind of my pitch for next year as focusing on defensive growth, but meaning that even in a market that continues to perform well, these utilities will compound at double-digit rates. And similarly, I think Ishrith's discussion around Chinese equities included several items, including fiscal stimulus, for example, that may serve to buoy many of the securities, even in a counter-cyclical way. So ultimately, from a portfolio construction standpoint, I mean, as you know, we don't take binary bets in our portfolios. So these two are largely uncorrelated. They should each deliver double-digit compounded returns next year, and perhaps much more in the case of Ishrith stocks. But I really view them as complementary rather than opposing views.
Okay, thanks, Brian and Ishrith. We're going to move to some of the views from our local team here in South Africa. And we're starting with you, Rashad. Your investment case is that inflation is going to come roaring back. Take us through your views on why you think that's the case.
Thanks, Linda. So my thesis for 2025 is that just as people believe that the inflation dragon has been slayed, it roars back strongly in 2025. Because, and the basis for that is that the setup that we saw for high inflation, the environment in 2020-21 that drove inflation higher, a lot of those factors are really coming back over the course of this year and into next year. So if we look back, we saw this inflation spike in 2021, 2022, and that was something we hadn't seen in the developed markets in many years. Inflation had presumed to be dead. Even with the massive monetary stimulus post-financial crisis, it wasn't sufficient to get inflation back up again, and many presumed that inflation was effectively dead. However, the combination of factors in 2020 and 2021 did drive inflation in the developed markets to levels we hadn't seen in several decades. Now, what were those factors? Firstly, you saw supply constraints. That was brought on by COVID. This is an example of shipping prices from China to the US, logistics shut down, factories shut down. It was very difficult for goods to be produced, goods to be moved. And then as that eased, people, you saw people in lockdown, they were wanting to buy a lot of goods. And then as that eased, you saw people then wanting to consume services, go out to restaurants, travel. So you saw this prolonged inflation caused by these supply constraints. Second factor was monetary stimulus. This is a chart of the Fed's balance sheets. It shows the amount of money creation that happened. On the right-hand side, you can see that in 2020 and 2021, the Fed was increasing its balance sheets by trillions on a monthly basis. Even as it calmed down in the following years, those bars are still bars which are above $100 billion. So the amount of monetary stimulus we saw, money printing, exceeded that post the financial crisis on unprecedented level. So easy monetary policy, you combine that with the third factor of fiscal stimulus, checks being handed out. This is a chart of personal income in the US. That spike in 2021 was almost 30%. So we had this crazy environment where you had a recession on one hand, but incomes rising by 30%. And these three factors combined to create that spike in inflation, which it took a long time, which it took aggressive rate hikes to bring back under control. So it was only in 2022, when inflation was rising to 5, 6, 7% in the developed markets, that central banks around the world finally woke up and they realized that they needed to bring this back under control. And you saw aggressive rate hikes. We haven't seen these type of rate hikes from developed markets in several decades, but we saw that in 2022. It had a very negative impact on sentiment. turbulence on the markets, but eventually it did moderate inflation and cause it to bring it back somewhat under control. Not quite to the levels pre-COVID, but much closer to targets than where we had been in 2022. Now, heading into 2025, I think that there's a potential for the inflation shock to bite back strongly. And the reason for that is that the three factors I've outlined, which drove inflation higher in 2020 and 2021, are set to reappear. Not necessarily in the same way and to the same extent, but they all definitely are there lurking under the water. The first thing is the tariffs and the trade wars. The clash between China and the US is set to accelerate, and this is a chart of imports and exports coming out of China. And you can see that while imports have remained stable, exports in China have definitely increased, and their trade balance is at record highs. Ishrat outlined the dominance of renewables energy, the increasing dominance of electric vehicles, and the developed world, the EU has introduced tariffs on electric vehicles coming out of China. Trump effectively, he calls tariffs the favorite word in the dictionary. And while we don't necessarily want to take him literally, we do think that he is going to increase the tensions with China and the deflation that China has been able to export for several decades now may be at an end. The second supply constraint has been labor. So under a Biden administration, you saw almost 10 million illegal immigrants crossing the border. And while that has caused a lot of social issues, it's been a big factor in moderating wage growth. You haven't necessarily seen the spike in wages that you would have expected at a record low unemployment growth. In fact, from 2019 to 2024, immigrants have taken 88% of the jobs increases in the US. So if you curtail that immigration or even start with deportation, you suddenly have supply constraints from a labor perspective, and we think that could be inflationary going into 2025. Secondly, monetary easing. So while we're not getting the quantitative easing that we saw in the COVID period, we are getting synchronized a rate-cutting cycle throughout the world. The STARB is set to meet on Thursday. We're likely to get another 25 basis points rate cut in South Africa. But across the world, we've seen rate cuts over the course of 2024, and that's likely to continue into 2025. So monetary easing is set to stimulate the economy and set to increase money supply in the system. And then finally, the fiscal stimulus that we are continuing to see coming out of the US, budget deficits. We recently had the medium-term budget in South Africa. We're still getting deficits of around 4 to 5%. We're still getting stimulus coming out of the US. This is the graph of the trailing 12-month deficit. You can see that while the US economy is growing, while unemployment is close to a record low, the US is still spending it still has printing a deficit close to $2 trillion. So the overspending habit that was developing during COVID, the developed world, the emerging world, they're finding it very difficult to let go. Ishrat talked about the fiscal stimulus coming out of China. It's a global phenomenon that budgets are just not being able to balance, and we're living in a state of perma-fiscal stimulus. So if you look at these three factors, going into 2025, loose fiscal policy, easing monetary policy, and supply issues, this time coming out of trade and labor, while they may not necessarily be to the same extent of 2020 and 2021, they definitely are powerful forces. They're definitely bubbling under the surface. And we do think that the market is very complacent in terms of inflation. If you look at break-even inflations that are being priced into the market, currently around 2% in the US, back to its historic levels. Inflation in South Africa priced in around the 4 to 4.5% level, definitely towards the midpoint and even below the midpoint of our inflation target. The market's very complacent of where inflation is likely to print, despite the fact that these pressures are building under the surface. So how do we deal with that? We do think inflation-linked bonds offer the best risk return at this point in time, giving you excellent real yields. In the US, real yields are around 2%, the highest in 2 decades. South Africa, real yields at around the 5% level. Even if inflation is normal, you're likely to get good returns exceeding cash. And if inflation does bubble back in 2025, you're going to get excellent returns out of this asset class. So I think for me, inflation reappearing is definitely something you want to position for, and the market is giving you a good asset class in inflation-linked bonds to take advantage of that.
Okay, thanks, Rashad. Now, you drew some parallels with 2021, but one of the major differences that springs to mind for me is that back then we did see energy prices spiking, of course, because of the Russia-Ukraine war. And today, of course, as we mentioned in the intro, oil prices are actually falling. Now, one of the major drivers of inflation historically has been energy prices, and specifically the oil price. How does a backdrop of falling energy prices square with your view of inflation resurfacing?
Yeah, that's a good point, Linda. So you did see oil hit $120 a barrel for several months in 2022 as the invasion took place and gas prices were limited going into Europe, etc. So there was almost this energy squeeze which happened, which caused energy to spike. But that was quite some time ago. So we're now in 2024, and since that peak in the middle of 2022, energy has moderated and is a big part of the disinflation that we have seen. So we're not close to 10% inflation in the developed world. It's more towards the 3 and a bit percent level. And a big part of that driver is the moderation and the normalization in oil prices. However, that's in the rearview mirror. Oil prices are down towards the $70 a barrel. It's 40% down from its peak. Are they going to fall another 40%? Are we going to see $40 a barrel? I don't think with the cost pressures in the energy industry and the renewable industry, we're likely to see that repeated. And therefore, I think the disinflationary impact is actually in the rearview mirror.
Okay, now, Nick, I know you've had some thoughts on Rashad's thesis. What would your question be to him to challenge his views on how things might play out?
Yeah, obviously I agree with a lot of his thesis, but we always think about the other side. And was it kind of a flat earth growth in the US that leaves the inflation where it is? And my question, I guess, is what happens if we have a global recession? What happens to inflation in that world?
Yeah, that's a good point, because it is something that we think about. We've seen a lot of spending globally. It's driven above trend growth. So what happens if that growth runs out? Because the economies could be running on fumes at the moment. So that is definitely a risk. And if you have a recession, you're unlikely to see inflation as basically demand falls off a cliff, which is what we saw, effectively at the beginning of 2020. If we look at the asset class that I'm recommending to protect you against inflation, I'm talking about inflation-linked bonds, where we're getting real yields of 5% in South Africa, 2% real yield in the US. That's very attractive relative to its long-term average of 0. In fact, when we see recessions in the US, you usually see that real yield plummet as monetary policy comes in to take effect. And in recessions, that real yield generally goes down to minus 2%. So if you look at the fall from 2% to minus 2%, that's a 400 basis points drop in real yields. And we know that bond prices are inversely correlated to yields. And if you see that 400 basis points drop, the price rise that you're going to see on the bonds and the performance you're going to see on inflation-linked bonds is going to be excellent, despite the fact that you're not going to get the inflation carry aspect. The real yield aspect is going to be the big driver of return. So we're quite comfortable with the fact that inflation-linked bonds are likely to deliver you good returns in a rising inflation environment, while in a falling inflation environment, in a recessionary environment, the falling real yields will actually enable you to get good returns as well.
Okay, thanks, Rashad. Let's move on to your views, Vim. Your investment case for 2025 is that in order for investors to thrive, they need to tread carefully. It's a minefield out there. What do you mean by that, Vim?
Yeah, so maybe a big contributor to portfolio performance is actually simply missing the landmines. And we're going to talk a little bit about the importance of avoiding companies with weak business models. And then we're going to look at a recent example and also relate it back to similar risk we're seeing in the market today. So this chart shows the share price of unpack. Most of you will know it as a packaging company, and the management team will tell you about how they have world-class manufacturing facilities and blue-chip customers. But what very few people focus on is just how weak the business model is. The reality of this business is they are a price taker with very little bargaining power with their customers. They have a very high fixed cost base, which means they need the volume throughput through their factories in order to cover their cost. It's very capital intensive, and they actually need to inject debt into the business in order to make the returns work. So just to look at how capital intensive this business is, if we look at the cumulative capex spent since 2011, they've had to invest 11 billion rand into the business. So some of it went to driving efficiencies, some new plants, but a lot of it was actually just to maintain the current facilities. And all of it was funded through debt. So we saw net debt to equity going from close to 10%, which is moderate in 2011. It spiked all the way up north of 200% in 2023, and they were forced into a rights issue. Now, all this capex spend, what did it deliver to shareholders? We can see the accounting earnings from this business has been fairly muted up until 2017, and then the wheels just came off completely. But there has always been warning signs for investors. If you look at the free cash flow in 2013, it turned negative, and it's always been below the accounting earnings ever since. So the cumulative free cash flow from this business since 2011 is actually 3 Rand per share. And that's for a business that in 2014 was trading at 80 Rand per share. So a very big difference compared to the accounting earnings they presented to shareholders, which was closer to 16 Rand per share. Still not enough, but it's a figment of their imaginations. It never existed. So if you have high investment and you do not see the earnings follow through, eventually reality sets in and you need to impair your assets. And then the true economics of the business starts to be reflected. So we've seen these cumulative impairments writing off 100% of all the capital they invested since 2011 up until 2023. So anyone who claimed the business was trading at a significant discount to its assets, the impairments followed, and it turned out it wasn't real. Anyone who pointed towards a low price to earnings ratio, there was never any cash flow, and it turns out that was also not real, and the pain was borne by the investors. So going to a similar example today, so this is Sasol, lots of similarities. The share price has sort of been bobbing around for quite some time, and it's recently come under pressure. But the business model, again, is extremely weak. They a price taker, they sell a commoditized product, they're very reliant on the price of oil and also on chemical prices in order to generate revenue. It's a high fixed cost business, it's extremely capital intensive, and they're also injecting debt into it in order to try and make the returns look better. So from a capex perspective, this is what they've spent cumulatively since 2011. 554 billion rand has been invested. Some of it has been new plants, new plants and projects, and also a very large portion of it has been sustainable capex, just to maintain the current facilities. And again, they've injected debt into the business. It went from net debt to equity of 15% in 2011, which is manageable, all the way north of 95%, where they're sitting currently. And for all that investment, they've received nothing. The incremental uplift in earnings, even accounting earnings, is lower today than it was in 2011. And again, the real number to focus on is that free cash flow number. So cumulatively, free cash flow from Sasol since 2011 has been 20 Rand per share. The accounting earnings cumulative is closer to 540 Rand per share. And that big differential relates to the depreciation charge. What they put through the income statement is close to 16 billion rand that they claim they need to maintain the assets at, but the real maintenance capex number is closer to 32. So vastly overstated earnings, and what really matters is the free cash flow. So again, today we hear people talking about it's trading at a discount to its assets and it's a low PE. We don't believe it's real. Here's the cumulative impairments they've had to incur, writing off 42% of all the investments they've made since 2011. All of that's good. Where are we today? So this is just a very simple sensitivity chart to show the free cash flow from the business that they'll generate at various oil prices. So if we take the current oil price, which is $70 per barrel, we think they'll do around R2 per share in free cash flow versus a share price of close to R100. So definitely not an enticing number. And unless we see the oil price actually go above the $85 level, we think the business and its balance sheet and its ability to service itself is under real pressure, and plain could very well follow. So in conclusion, we're very cautious of businesses with strained business models, and we think investors could end up paying a very high price for what appears to be an optically cheap share, and we'd rather stay well clear.
Okay, thanks, Wim. So now you've outlined a number of characteristics that we look at in businesses that we avoid. Perhaps you can give us some examples of the opposite of that, some businesses that we feel are compelling today.
Yeah, it's interesting. As an investor, you never know what comes across your desk. But recently, we've seen the Boxer IPO coming to market, and we think it's a very compelling opportunity. So they are almost the inverse of a Sasol. They have a negative working capital cycle. It's very capital light in terms of rolling out the stores. The free cash flow is extremely attractive, and they generate returns on invested capital north of 40%. On top of that, it's in a defensive industry. So food retail, we think we've got a fair understanding of where the business will be 5 to 10 years from today, and they've got a long runway still for growth ahead. So much rather be invested in a company with certainty where we believe we got a handle on the future than something that's very tenuous like a Sasol.
Okay, so Wim, these are all very much bottom-up sort of criteria that we might consider at a fundamental level. Let's switch tack a little bit and look at the overall environment. How has the formation of the GNU and the potential uplift that we may see, hopefully, in terms of economic growth, how does that influence the type of companies that you'd be looking to buy?
Yeah, there's a lot of optimism at the moment that the GNU will lead to better economic growth. We're not that sure. We think it could transpire, but our preference remain very much for companies that do not need economic growth in order to deliver for shareholders. So we're more focused on high free cash flow businesses that are well positioned, that can continue to take market share and continue to deliver for shareholders, whether we see GDP growth at 1% or 2.5%. We think there's some ice cream to be had if we're off to the races, but we rather continue to play in the high quality space.
Okay, fair enough. We come into our last investment case, which is yours, Nick, and that is that hospitals will be healthy. Well, I suppose hospitals will deliver healthy returns, even in the face of NHI. Take us through your thoughts on this.
Yeah, I think I probably got one of the tougher sells, but I think, to be honest, that's what we like. You know, when people have perceptions that how can any of the hospitals thrive under national health insurance, I think that's where the opportunity is. And I think it's right. I think NHI is a scary and complex concept, and I think not everyone understands what it really means. So I'm going to try and simplify what NHI really is. I will miss some of the nuances, but I do think the simplicity is important to explain what it is and what its implications are for the hospitals. Interestingly enough, my conclusion will be that the hospitals will probably be the most resilient part of the economy should NHI actually be implemented. I'll take you through some of my thinking. If we start with what is the current landscape, sometimes before we get to what NHI is, what have we actually got in South Africa currently? Most of us know this, but I do think it is important to set the base. At the moment, anyone in the country can go to a government hospital and get help. At the moment, if you have money, you can also buy a medical aid, and then you can go to a private hospital. They are very separate, but you have the ability to go to a public hospital, which means actually we already have some form of national health insurance or universal health. The problem is you don't get the care you need generally when you go to a public hospital. So what is this proposed NHI? I think, as I said, it is quite scary, but when you break it down, this, in simplicity, you are going to have the healthcare procured and funded through the government. What that means is there will be no longer any medical aids. You will procure all of the government will procure all of the healthcare, and they will funnel it through the GPs of the country. The GPs will then allocate the people either to a public hospital or a private hospital. The problem is the medical schemes will not play a role and therefore not be able to oversee the outcome of care. And I think that is quite a big risk for NHI. One of the biggest risks, and obviously why NHI will probably take a very long time, is it needs more than 200 billion, and that's a very conservative number, to bring the public hospitals up to the requirement. And as of now, actually the public hospitals will struggle to get the certificates needed to actually service the people coming to the public hospitals under NHI. Another huge issue is that the gatekeepers, which are the GPs, are in the wrong places. There's been a big court case around reallocating these GPs to the areas of need, which actually was won, and now the government cannot allocate GPs against their will, which is a big hindrance to the NHI. And then also, obviously, it will take a very long time. Conservatively, without any court challenges, it will be more than 6 years before NHI is established. So, importantly, private hospitals still have a big role to play in the national health insurance, which I think people do forget. Obviously, one of the biggest risks is that they contract at an unfavorable rate, which does scare away some doctors. I think that is a bigger issue for the country as a whole. I think you've got to think through some of the amendments that can take place that will make NHI maybe more sustainable, not particularly perfect, but I think acceptable. What you need to do is you need to see the medical aids be re-established, that you can, over and above, take out a medical aid if you choose not to be in the net with the government in the NHI. The other important thing is you need to live within your funding requirements. Right now, the government has a really great pipe dream, but we know that the tax take can't take it because there will have to be a substantial tax increase to fund the intended 200 billion rand investment required. So we think that just accepting that you live within your means on a reduced amount of funding is one of the key criteria, and also accept that this isn't going to be a 6-year journey, but actually it will be more like a 15-year journey. Importantly, as I said, the medical aids are the custodians that make sure that the hospitals behave. We do see that as important, but also importantly, you need to allow an independent board to uphold the public hospital outcomes. So with those few tweaks, I do think that that will be a slightly more sustainable outcome. Importantly, once again, in this scenario, the private hospitals continue to play a role. In fact, they benefit from both being a service provider to the government, but also providing over and above healthcare to the medical aids. Something that's building in meetings that are happening between government and the private sector is a proposal by HASA. HASA is the Hospitals Association of South Africa. They're proposing something slightly alternate to the NHI, and it's more like the first example and the current outcome that we have at the moment, where the public will be serviced by the public hospitals and the private sector that take out a medical aid will be serviced by the private sector. Why it works and why it is a really sustainable model that we really are in favor of is that what happens is the government will, the government will mandate medical aid insurance for all formerly employed people. This will double the amount of medically insured people that enter the net on the medical insurance. Importantly, that's more healthy participants, which makes the medical scheme much bigger and healthier, which means that they're able to fund more people in the private sector. At the end of the day, that takes out people from the public sector. So the public sector has the same amount of funding, but with reduced amount of people to look after. I think it's a win-win, almost like the private sector participating in the education segment, which takes some pressure off the public sector and can enable more people to be in the private sector. Importantly, this is the bull case for the hospital groups in that there are double the amount of people and there are way more ways to monetize those people. And importantly, the care will also increase both from the private sector and from the public sector. So I think this is a really interesting uh, angle that is gaining traction in the market at this moment. I'm just going to have a sip of water with my croaky voice. Turning to the actual hospitals and what that actually means, I use an example which is Netcare, and obviously based on all of the examples that I said, they are going to be quite delayed in the NHI implementation, no matter if it happens or not. Importantly, Netcare, as an example, the bed occupancy rate has increased substantially back to the long-term average. That means that it is not a company, and almost like Wim was saying, it's a company that doesn't need the GNU to really work to a certain extent, because we haven't built in that big a revenue growth. So the revenue growth is there and thereabouts of 5%, which isn't really that interesting on its own. The difference is, though, that Netcare has been investing significant amounts of money in its infrastructure and its IT systems. You can see that it almost just over 100 million rand has been invested, which is the red line in the bottom left-hand corner. As you can see, sorry, the blue line. As you can see, the blue line has peaked out and they've spent all they need to spend on the IT, but the red line is the benefit that they're going to achieve from being much more efficient in servicing the patients inside of Netcare. Importantly, that translates into a much higher EBITDA margin. Sorry, I'm going to take some more water. That translates into a much higher EBITDA margin, which is important because it translates into almost 16% earnings growth, which is the top left-hand corner. So with 5% revenue growth, very solid cost containment, and also that benefit from the IT system, you can see significant earnings growth. At the same time, as Wim said, importantly, the free cash is also very good, almost yielding 9% free cash in the 2025 year. We've just separated for the dividend in red being paid out and the excess cash that stays within the business. Because of all the risks that people perceive but don't really understand with NHI, the current multiple of Netcare is less than a 10 PE. That is a really cheap valuation for that type of earnings growth, and the balance sheet on the other side, which is the last slide, which is improving every time. Importantly, the long-term average PE is significantly higher. We see no reason why it can't get back to the long-term average. All of that together, yes, there are risks. Yes, there are perceived risks. There are complexities around NHI. Importantly, the private sector hospitals will continue to play a role no matter what in any of those scenarios. There is absolutely more risk to the medical aids, as I showed you, because there are some scenarios that they do bypass the medical aids. So we think that the opportunity remains in the hospitals, notwithstanding the NHI. The valuations are good, the balance sheets are healing, and there's good free cash flow and earnings growth to come.
Okay, next, so you spoke about the fact that NHI might take some time to be worked out in terms of what sort of form it'll eventually take. Now, we know the market doesn't like uncertainty. So that's part of the reason why valuations are low for these businesses. Won't that negative sentiment continue to weigh on valuations for businesses like this?
Yeah, I think it's almost a similar question that you asked Ishwith. I think one of the key things that at Foord we really care about is what is fundamentally the business we're buying? What are the earnings and the free cash flows that we're going to get? And then we also think about the price we pay. All of those are boxes that we tick for Netcare. The one thing that we know is there will continue to be uncertainty, which means it doesn't look like there's a prospect for a near-term re-rating in the PE. But if you have 16% earnings growth compound for the next 5 years, you have a good free cash flow and a balance sheet that's really good, actually what happens is management take advantage of it. So Netcare have spent almost R1 billion over the last year, bought back almost 6% of the company at 20% below the current share price. So I think importantly, you buy those kind of companies because they will deliver for you no matter if the PE changes or not. So for us, it's a company that doesn't need the rating to change for it to perform very well.
Okay, and the low valuation gives us an opportunity, of course. Yeah. Right, are we going to actually launch the poll to see who had the most convincing argument? So you should be seeing some options on your screen. Let's just go through those. The first was China will be one of the best performing markets in the world. That was presented by Ishrith. The second was boring will be better. Brian outlined the case for defensive, such as utilities. He believes that those will outperform the overall US market in particular. Rashad, you outlined the case that inflation will come roaring back and that as a result you need to buy inflation protection in portfolios. Vim, you think it's still a minefield out there and that 2025 will be as much about avoiding those landmines as it is about what you do invest in. And then lastly, Nick, that hospitals will deliver healthy returns despite or maybe even because of NHI in the longer term. But certainly for 2025, that the hospitals will be fine nonetheless. Right, so whilst we actually get those results, if you could just give us your views on that. Nick, we've seen some great returns out of the South African equity market, as I mentioned, just under 20% in US dollar terms from the overall market, and our Foord equity fund has done even better than that. So I guess the question that everyone is asking is, how confident are you that as a team we can continue to deliver good returns within, some might argue, sort of the confines of the South African equity universe?
Yeah, interesting. I probably need the NHR after my talk. But yeah, I think importantly, it's exactly what Vim alluded to. You don't know what's going to come across your desk. Boxer for us is a very interesting opportunity. There are always going to be interesting opportunities. What you need is to have a very high quality team, a philosophy that you really believe in, that's time tested more than 40 years, a process that works, and also, as I've always said, hire the right people, because there's a lot of gray that happens in investments. You have to have the right people at the right moment doing the right analysis and ready to push the button on any investment to take advantage of it. Important, we're small enough also that we don't have to be the market, so we can be nimble and act quite quickly to take advantage of the opportunities. So I really do think we look forward with confidence that there are many things that we can do for the portfolios that excite us.
Great, thanks, Nick, and that gave us a chance to get everyone's votes in. I can say that 70% of people who are online actually did participate in the poll, so this is quite a fair representation. It was very close. I'm going to share the results. And the winner is, the most convincing argument was you, Vim. I think there are a lot of people who agree with you. It is a minefield out there. 2025 will be about avoiding those, so it's very much about making sure that you don't invest in things that don't turn out well. But very close second is Ishrith, with China will be one of the best performing markets in the world. So yes, you can see the other results there. After that was inflation will come roaring back. Potentially, maybe the audience thinks that's a little bit further down the line, Rashad. And then, of course, boring will be better. And then, yeah, Nick, I think the NHI is still a concern for everybody.
I think it's going to give me a chance to buy more, so it's fine.
Okay, great. Well, that is all we've got time for. We've actually just gone slightly over time. Something I just wanted to remind everyone about is that we do produce podcasts. So if you are somebody who enjoys listening to podcasts while you're at the gym or if you're in your car, please look for us on Spotify or Apple. You can just search under Foord, F-O-O-R-D, of course, and you can subscribe to us, and that'll mean that your feed automatically loads our most recent conversations. Lastly, there's a survey that's going to pop up on your screen when you end your session or when we end the session, either way. Please do give us your candid feedback. We want to make these sessions as useful as possible for you. And with that, I just want to thank my team. Thanks Nick, Rashad and Vim. Thanks to Brian and Ishrith in Singapore. And thank you to all of you who've joined us. A particular thank you to those who are invested with us. Thank you for your trust. And last, to wish everyone a very restful holiday season. Nick, it sounds like you need one. And we'll see you all back here in 2025. Thank you very much.